Federal regulators are proposing strict new rules for the nation's biggest banks. The Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency are all teaming up to make sure banks increase their ratio of equity to loans and other assets from the current 3% to 5%. And they've also set aside higher reserves for their deposit holding units. Kayla Tausche joins us now with more on what this means for the nation's biggest lenders. Kayla, people are always worried through all of this financial crisis, are the banks safe? Do these new rules mean that we can sit back and say the banks are now safer?
It would appear to be so, Susie. This is one of the tenets of regulation that these policymakers have been alluding to for several years now. It limits the amount that banks can borrow to fund their activities, especially short-term debt, so that if push comes to shove, they won't have as much debt outstanding. There won't be as many investors on the other side of that debt. And also banks will be able to fund their activities from day to day. The hope is by eliminating some of that risk in the system, they will make the banking system safer.
This means they have to have basically more capital. They can't take as much risk. What in turn does that mean to the investment prospects of the banks? If I'm a stockholder in one of these banks, are they going to be able to grow as fast as they otherwise would have been able to?
I don't think so, Tyler. A lot of people are talking about the banks like utility stocks. We've heard that mentioned for a long time, but regulators specifically want to make sure that the heady days pre-crisis, when banks were returning as much as some hedge funds, are over, that banks won't be levering up their balance sheet, i.e. borrowing more, to reinvest some of this capital to beef up their returns and make the big profits that they did before the crisis. Regulators want them to have a very steady earnings stream. Even that, if that's a lower earnings stream, they'll be able to buy back stock, they'll be able to issue dividends. But if you like utility stocks, that's where the banks are heading.
And so what does this mean for loans? We've heard over the last couple of years how difficult it is to get any kind of loan, a mortgage, a car loan, whatever. What about now?
Part of the criticism of the lending environment is that because lending dried up almost entirely during the crisis, it's taken a long time for banks to bounce back. Regulators say, one of the leading voices behind this regulation actually said that what happened in 2008, 2009, 2010 was a lending implosion. Loans dried up almost entirely, and that because we're now having a bigger capital base, some banks won't ever have to stop lending, even though the growth might be a little slower.
Well, that's good news. Kayla, thanks so much for coming by. Kayla Tausche.
Thank you.